Day and welcome to the Amber Enterprises Q1FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jasbir Singh, Executive Chairman and CEO and Whole-Time Director of Amber Enterprises. Thank you, and over to you, Mr. Jasbir Singh.
Hello and good morning, everyone. On the call, I am joined by Mr. Daljit Singh, Managing Director, Mr. Sudhir Goyal, CFO, Mr. Sanjay Arora, CEO, Electronics Division, and Mr. Sachin Gupta, CEO, RAC and CAC Division, and our Investor Relation Advisors, SGA. We have uploaded our result presentation on the exchanges, and I hope everybody had an opportunity to go through the same. Q1 of FY24, which is usually a strong quarter for the RAC industry, was marked by unseasonal rains and weather patterns. Owing to the muted demand that industry witnessed, the channel inventory stood at elevated levels and is expected to come down to normalized level by end of Q2 of this financial year. In H1 of calendar year 23, industry has declined by approximately in a range of 20 to 25%. However, we expect RAC industry to grow by 7 to 8% on year-on-year basis for financial year 24, which augurs well for Amber. As mentioned earlier, we had anticipated the changing trends in the RAC industry and has created diversified solutions by expanding our offerings under components and sub-assembly segment. I will now take you through the consolidated financial highlights. On the revenue front, for Q1 FY24, revenue stood at rupees 702 crores versus 1826 in Q1 FY23. On operating EBITDA, for Q1 FY24, operating EBITDA stood at rupees 138 crores versus rupees 131 crores in Q1 FY23, a growth of 6%. Operating EBITDA margins for Q1 FY24 stood at 8.1% versus 7.1% in Q1 FY23. Our component strategy, which led to product mix change, has helped to improve these margins during the quarter despite weak demand in RAC owing to unseasonal weather patterns. Operating EBITDA is before impact of ESOP expense and other non-operating income and expenses. Now moving to the divisional performance. RAC and Components Division. For Q1 FY24, revenue stood at 1244 crores versus 1439 crores in Q1 FY23. For Q1 FY24, operating EBITDA stood at rupees 96 crores versus 86 crores in Q1 FY23. Margins during the quarter improved on account of component strategy, which led to product mix change. RAC and Components Division is expected to grow faster than the industry growth in FY24. On Mobility Applications Division, which includes Sidwal, for Q1 FY24, revenue stood at 104 crores versus 95 crore in Q1 FY23. For Q1 FY24, operating EBITDA stood at 21 crores versus 26 crore in Q1 FY23. Q1 FY23 margins had benefited from low-cost inventory base and hence not comparable with Q1 FY24. However, sustainable margins of this division would be in the range of 20 to 22% at the current commodity prices. We expect Mobility Application Division to grow in a range bound of 15 to 20% in this current financial year.
There are more than 20 parties in the conference.
We are at last leg of receiving a large order in this division, which will take our order book to close to about 800 crores. On the electronics division, which includes Engine and Ever, for Q1 FY24, revenue stood at 267 crore versus 208 crores in Q1 FY23. For Q1 FY24, operating EBITDA stood at rupees 11 crores versus 9 crores in Q1 FY23. Electronics division has witnessed growth in revenues as well as operating EBITDA. Currently, large part of the demand of PCBAs for non-smartphone applications is fulfilled via imports. Government's thrust to manufacture electronics locally present a multi-fold growth opportunity for this division. Electronics division is expected to grow in a range of 35 to 40% in FY24. On the motors division, for Q1 FY24, revenue stood at rupees 87 crore versus rupees 83 crores in Q1 FY23. For Q1 FY24, operating EBITDA stood at rupees 10 crores versus rupees 10 crore in Q1 FY23. We were able to maintain our revenues and operating EBITDA owing to new product range introduced in previous quarters. And motor division is expected to grow in a range of 20 to 25% FY24. Exports grew by 40% in Q1 as compared to previous year same quarter.
There are more than 20 parties in the conference.
With this, I would now open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two.
There are more than 20 parties in the conference.
Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Very good morning, sir. My first question is with respect to the electronic segment. We have seen very good growth in the segment in the first quarter of this year. Margins are somewhere in the range of around 5%. Is there a scope for this to improve? What can be the drivers of improvement in terms of margins? And if you can talk about the growth drivers also for this segment in slightly more in detail, it would be great.
Yeah, good morning, Ravi. Yes, this margins, you're right, is in the range of 5%. When we bought these companies, it was in the range of 3.5%. We are moving towards 6% range, and that's what we guided, that in next 2 years' time, we should be hitting those numbers. Because the reason is that the new orders which we are taking and the new applications which we are entering into are coming with a slightly higher margins. And we are very bullish on this divisional performance as well as the future growth perspective of this division. When we bought this company, this was actually in the line to air conditioners moving from fixed speed to inverters. But when we entered into this company, we saw that it's an ocean of opportunities, and we started diversifying it into various applications. So today, apart from air conditioners, this division is serving refrigerator, washing machine, microwave ovens, water purifiers, fans, and also hearable, wearable, and telecom sector. And we are also adding newer applications moving forward. So we are very bullish about this divisional of ours.
Got it, sir. Got it. Understood. And the second question is with respect to the mobility business. So, is there any large order opportunity which are there in the pipeline from metro side or other railway segment side, which can give in large orders to this particular category?
Yeah, certainly. I mean, you must have been hearing a lot of news on the modernization of railway program, and almost about 25 to 26 new cities where tenders are getting opened from Urban Development Ministry for newer metro lines, and the existing metro lines are also expanding. So we are having two strategies here in this division. One is, of course, our HVAC offering has now moved to railway and then metros, and we are serving almost every customer in this range. And then we have strategized to move into deeper wallet share within the existing customer by offering products like pantry systems and gangways and doors. So that is also moving very fine for us. We've done 2 technology agreements with 2 companies, one in Canada based and one is a Taiwan based company, and for the doors and gangways. We are hopeful to start getting orders in this category also. So larger aim and the long-term aim is to make Sidwal a multi-product company in the rail subsystems category, and moving into the line of India, which is it's a next 10-year story for railways and metros. So we are quite bullish on this division as well.
Sorry to interrupt, Mr. Swaminathan. May we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Our next question is from the line of Sonali S. from Jefferies. Please go ahead.
So thank you for the opportunity and congratulations on a great set of margins. So my first question is regarding margins itself, about 7%, more than 7% this quarter. You mentioned product mix changes. So could you give us more color as to what exactly were the product mix changes and how sustainable do you foresee this margin trajectory to be in? Do you think the coming quarters can sustain at about 7 to 8% from here on, also because of the PLI benefits coming in?
Thank you, Sonali, and good morning. Yes, the margins expanded and the prime reason is that, as we explained in last couple of quarters, that we are shifting our strategy towards more of components. That's what led to this margin increase. And both AC as well as non-RAC businesses, which we've added in last couple of quarters, are paying dividends now. On the percentage terms, I will again reiterate what I've always said, that it is very difficult for us to predict the percentage of margins because of the high product mix which we carry as a solution provider. Yes, but we will maintain our guidance that on the absolute EBITDA basis, you will see a jump of 25 to 30% on the EBITDA levels.
This is year on year for FY24, right? Sir, any pricing actions that you have taken in Q1 so far?
No, there was no need of taking any pricing action because the commodities are more or less on the same level. So there's no change in the pricing.
Thank you. Ms. Sonali, may we request you to return to the question queue for follow-up questions. Thank you. Our next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi, good morning, sir. I have 2 questions. First, you have highlighted various new emerging areas where we see developments coming through and companies expanding. So what kind of investments are you expected to do in the next 18-24 months across these segments? If you can elaborate.
Morning, Renu. We've guided earlier that total capex for this year is going to be in line of 350 to 380 crores range. And that is primarily because of maintenance capex of all 27 plants plus the R&D initiatives. And also, as explained, that our divisions are now moving into different applications, so we will need some capex in the divisional part also for expansion of our capacities for newer applications which we want to address.
Sure. And the second question is on the growth side. While in RAC components, you mentioned you'll be growing faster than the industry. In the earlier interaction, you mentioned the industry may at best be flattish or may decline for the full year. So how should we look at the RAC and component business growth? And simultaneously, in mobility, when we're getting into many adjacencies, you're guiding for only 15 to 20% growth for Sidwal. So is that not slightly more conservative given addition of new capabilities and markets that we are looking within the rail portfolio?
Yeah, on the second question, on the mobility side, Renu, basically the newer applications which we are getting into as a multi-product company for train subsystems, that will start paying dividend from next year onwards. So this year we have already closed the TOTs. Now on the phase 1, we are taking prototype orders, and then we will be furnishing these prototype orders by Q4. And from next year, Q2 starting, we will start getting the reflection of this multi-product strategy of ours in Sidwal. So we are expecting to double Sidwal revenue as well as bottom line in next 2 to 3 years time. That's the strategy moving forward. On the room AC, what was your question? On the component side, yes, I mean we are adding new customers on the component side, and also because the customers have shifted their strategy to in-source largely, and we've been able to proactively change our strategy in tandem with the customer strategy. So that is what is making us more confident to deliver more than industry growth. So industry, earlier we've guided that our industry will remain flattish, but now looking at the July and August order book and September order book, I think industry should come up in a single digit growth patterns by this year end, and Amber should deliver more than the industry growth.
Thank you. Ms. Renu, may we request you to return to the question queue for follow-up questions. Our next question is from the line of Anupam Goswami from SUD Life. Please go ahead.
Hi, sir. Sir, my question is a little follow-up. You mentioned about July sales, and looking at the growth, you expect about 7 to 8% growth in the RAC. If that's so, then Amber could be in the range of double-digit growth, let's say 15 to 18% in the RAC?
It will be very difficult to predict whether it is 15 to 18%, but I think we should be at least 3 to 4% higher than the industry, at least moving forward, looking into our strategy, which is moving.
Okay. And sir, you mentioned about Sidwal growing double digit. So do we, in the multi-year product that we are mentioning, do we maintain the margins of about 20%?
Yeah, Sidwal maintainable margins are in the range of 20 to 22%. If you would have seen the last 4 or 5 quarters, it changes, it varies from quarter to quarter, because sometimes we have AMC contracts billing happening, sometimes we don't have AMC billing happening, and then other way there is a product mix of bus air conditioning, defense applications, plus metros and railways. So on a yearly basis, 20 to 22% is maintainable.
Thank you. We move to our next question. Our next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Sir, one question, primarily the split between ACs and RAC and components. Could you talk about rough margins in both of them? Because, we've seen a period 2.5 years back where our margins went from 8 to 6. And again, in this quarter, we have jumped to 8%. So just for us to be able to understand this better, what is the margin in your RAC business and your component business approximately?
Good morning, Pulkit. Actually, this is a very company-sensitive information, and we would not like to highlight on the complete vertical split. So we have a range. I can talk about the range. The range of finished goods to component varies from close to about 6% to almost about 9%. That is the range on which we supply various modules, whether it is finished goods or it is the component.
Okay, this is helpful, sir. And can you talk about proportion in both of them?
Proportion, yes. RAC proportion is reducing now. You would have seen in the presentation also that I think from it used to contribute close to about 68% a couple of years back. Now only 48% is RAC in the complete console balance sheet, and more of is it components adding up.
No, I'm asking in that standalone between RAC and components, what is the proportion?
Yeah, earlier it used to be 70-30, but now we have reached to almost 50-50.
That's helpful, sir. Thank you so much.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Hi, good morning, sir. My first question is, you mentioned in your presentation that industry is expected to grow by 7 to 8%. So I assume this is at a RAC and component level. So even if I take a 7% growth, sir, at the current market operating price, I come to a volume of about 9 million units. So just wanted to understand, will we be able to do that kind of volume given that quarter one's already gone and it was a bad quarter?
Yeah, we are hopeful that it will touch about 9 million numbers, because what we are seeing right now is the inventory getting liquidated in quarter two. And generally, whenever this kind of trend happens, because we've seen such bad seasons 4 or 5 times in our history of last 22 years. So there's always a sudden jump in quarter four, and which leads to a single-digit growth trajectory, and that is what should happen this year as well. So we are very confident of that market should come to about 9 million. Industry should come to 9 million this year.
All right. And so just on the market share, so if we are expected to do a 3 to 4% higher than industry, would that mean your market share would come to around 31% in FY24 from 29.4? Can we expect that?
We should expect some big, good trajectory beyond 29%, as we are adding more components, and we've added more customers also in both components as well as in the finished goods category. So
all right.
We should see that. Yeah.
Okay. And so my second question is on the motors division. So we've been hearing throughout, the previous con call that this segment is expected to show strong growth, especially on the back of exports. Now, when I see the quarter numbers, it has not been a very high growth area for us. So first, if you could just tell us the split between domestic and exports, and how do we see this segment going forward?
See, earlier the export was contributing in a single digit, 7 to 8%, but now export is contributing about 11 to 12%. And that's why in my commentary, I said that we've seen about 40% jump in our export orders in quarter one as compared to last year, quarter one. So moving forward, we are expecting some good growth in quarter one. But the reason why we are changing the guidance instead of 30% to 20 to 25% is because looking into the bad season right now moving on. And most of the customers, they have high inventory of this product category with them. So even if they liquidate the inventories, the larger order book will start coming from quarter three and quarter four end. So exports will be positive for this division, and we'll continue to maintain the margins in which we are.
Thank you. Ms. Natasha Jain, may we request you to return to the question queue for follow-up. Thank you. Our next question is from the line of Karan Sanwal from Niveshaay. Please go ahead.
Hello. Am I audible?
Yeah, Karan, you're audible.
Yeah, thanks for the opportunity. So my question was, I wanted to understand the capacity utilization in our facility at a major consolidated level.
Very difficult to answer your question, Karan, because we have 5 divisions and all the divisional capacities are at different levels. But if I want to give you a gist of divisional capacity utilization, I think if I talk about motors, we should be at about close to about 50% capacity utilization. We just moved into a newer factory last year in that category. On RAC, we will be again talking of about 50-55% capacity utilization because we did 2 greenfield facility expansions. And on Sidwal, we'll be in mobility application. We are at about close to about 65 to 70%. And in components division, again, some of the components we are at 65 to 70, and some of them we are at 50.
This was helpful. And my second question was, I wanted to understand what percentage of our raw material are imported, and maybe which country would be contributing those major chunk to those imports.
So on the imports of raw materials, as guided earlier also, you must have seen in our balance sheets that we pass on any price fluctuations on the raw material side to our customer at a quarterly lag basis. But yes, there is a big trend which is changing due to PLI, which is that the component ecosystem is getting built now in India. So we expect the larger objective of PLI was that the local value addition, which was currently at 25% in FY21, should go to about 75% value addition in our country within next 5 to 6 years time. And we are seeing that this trend will go to about 50% by next year itself. So PLI is playing its role of creating a component ecosystem. I think in next 2 to 3 years' time, our import content should come down.
Thank you. We move to the next question. Our next question is from the line of Mr. Pankaj Tibrewal from Kotak Mutual Fund. Please go ahead.
Good morning, Jaspreet.
Good morning,
Can you give us some color on the balance sheet? How is it shaping up? And on the return on capital, the trajectory which we have been talking about, it will be a lot appreciated. Thank you.
Pankaj, as guided earlier, that we already touched 15% of return on capital employed last year, and I think we are looking towards doing about 16 to 16.5% this year. And as guided earlier, I would like to reiterate that in next 2 to 3 years' time, we should be in the range of 19 to 21%.
And any color on the balance sheet as we speak? Because interest cost has moved up quite substantially. So just some color on the overall balance sheet debt numbers.
I'll ask Sudhir to answer this question.
Yes, so, hi Pankaj, good morning. So what kind of a color you are looking for in terms of balance sheet, like what exactly you want to know? Because in
from
terms
the
of
gross and net debt and the capex done in the first quarter and the cash flows.
Yeah.
If you can just help us on that.
So cash flow we have not prepared still, but I'll give you a separately after calculating the number of cash flow. But
Sure.
in terms of the net debt, we have a net debt of 788 crores as on 30th June. And the capex done is around 40 odd crores in the quarter one.
And this year you're talking about 350 to 380 crores of capex.
Yes, yes.
Okay, fair. And just one, kind of a check back. And this return on capital number which you're talking about includes other income, right? That's how you get to 15% last year.
Yes. It is on EBIT. It is on EBIT.
Cash line, other income.
Yeah, other cash. Yes.
Okay.
So it is a cash line. It is like other income includes the interest cost and everything. So it is on the EBIT.
Okay. So you are including the other income. Fair enough. Thank you.
Yes.
Thank you.
Thanks.
Thank you. Our next question is from the line of Alok Deshpande from Nuvama Institutional Equities. Please go ahead.
Yeah, good morning, Jaspreet. First question is on the electronics division. It's now at an annualized run rate of nearly 1,100 crores. So, any color so you can give on what is the product-wise split within that electronics revenue?
Right now, almost 30% revenue is coming from hearable and wearable, and 70% is consumer durable. But we've started small shipments in the telecom sector. So by year end, I think the consumer durable and appliances sector should come to about 55 to 60%, and 40% should be the other hearable, wearable plus telecom.
Okay. And consumer durable is a mix of different products, I'm guessing, different appliances.
Yes. In consumer durable, we have AC, refrigerator, washing machines, microwave ovens, water purifiers, and TVs.
Okay, understood. And just quickly on this quarter gone by, if you were to split this quarter into, let's say, two halves, did the first half of the quarter one was something where you had the majority of the sales, and later on the sales were lower, because you're talking about inventory, sort of channel inventory being elevated in the channel. So I'm guessing the second half of the quarter would have been muted. Is that the right understanding?
So generally, in quarter one, if you see previous year's trend also, the April month is the peak month. Then it starts slowing down from last week of May, and then it slows down in the June. But this year, April itself was a dissuader because of the unseasonal rains. So I would say it was like a standard kind of quarter for us, where because of the rains, a lot of inventories were stuck, because April there was hardly any sales in the finished goods category. So there are companies who couldn't sell it. They were down by almost 40%. There were some companies who are flattish. So on an average, industry was down by about 20 to 25%, and that's how the elevated levels of inventories are there in the system.
Thank you. Mr. Alok Deshpande, may we request you to join the question queue for follow-up questions. Our next question is from the line of Gunjan Kabra from Niveshaay. Please go ahead.
Sir, thank you for the opportunity. So I wanted to understand, you did touch upon this point in the previous participant question, but I wanted to understand that, these days all EMS companies who are giving, components are doing a margin of, say, 15-17% in the component business, maybe in PCB board supplying to consumer electronics. Sir, so what is, if we are moving towards more on the component side, then what kind of margins can we see, and why is it, like, if we ramp it up, then how much can the margin increase? To what levels can it increase is what I wanted to understand in the component business, and why are we doing it low compared to, other EMS companies who are doing it? What would be the difference? I wanted to understand.
So basically, there are EMS companies which have 4% EBITDA, and there are EMS companies in the electronic sector which have about 11 to 12% EBITDA. It depends on which applications you are serving to. So there are about 9 to 10 sectors where you can address or deliver these solutions in the electronic space. Starting from the lowest margins are in our sector, which is consumer durable and home appliances, and then moving on further, in the industrial and healthcare sector, it is more. In auto, the range is about 7 to 9%. But if you start catering to defense applications and railway applications, then it is 11 to 12%. So we started this division by equity infusion 4 to 5 years back, primarily because of air conditioners. But then when we saw that it's an ocean of opportunity, we started diversifying. So what we are doing is we are bringing in more applications, and that's the reason why we have guided that our margins will slightly improve in coming years to come. And as we continue to add more applications, we can also reach to that level, but it will totally depend on when we are able to crack the customers in that range of higher margin businesses.
Okay, thank you so much.
Thank you. Our next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Hi, sir. Sir, I had a question on the... Yeah.
Dhruv, you were not audible. Can you repeat your question?
Hello?
Yes, sir. Please go ahead with your question. You're audible now. Mr. Dhruv, there seems to be a problem with your connection, I guess. Could you unmute your line, please? May I request the management that we move to the next participant?
Sure.
Thank you, sir. Our next question is from the line of Madhav Marda from Fidelity. Please go ahead.
Hi, good morning. Just wanted to get, I think you mentioned in the initial part of the commentary, but the RAC industry growth this year, how do you expect it to shape up through the rest of FY24? Is my understanding right that Q2 could be a bit better than Q1 because Q1 was a lot impacted, and then you're expecting Q4 to be a much better one as inventory is normalized? Did I understand that right?
Yeah, basically we are seeing some uptake in July month, and I think if the inventories get liquidated in quarter 2, then quarter 3 and quarter 4 should be positive. But quarter 4 will generally be positive. We have seen this trend of bad seasons earlier also. I mean, within the bad season, this was the worst season which we saw. But it bounces back. It's a strong comeback whenever this kind of thing happens. So, CAGR of industry gets maintained. So I think we are quite bullish looking into the trend of now sales of most of the large companies. We think that industry should come up in a 7 to 8% range.
Got it. And July, you're saying absolute volumes could be a bit better than what we've seen in Q1, like despite that being a sort of the summer season?
On secondary sales, yes, you're right. July would be a little better on the secondary sales part of it. Primary sales, I would not say, because primary sales dealers are carrying inventory, so they have started selling those in July and August.
Understood. Yeah, and just second question was on Sidwal. I think you did mention that there is a lot of traction in the end market, which we are seeing on the infrastructure side. So, how could growth be here? Because there's so many new projects coming up on the railway side, metro side. So how Sidwal could benefit? Because what we understand, you all do have very good market share in this space in India. So just your thoughts there.
Madhav, I explained it earlier. I'll repeat it again. So we are following two strategies. One is, of course, we are penetrating deeply into the HVAC solutions for our customers, and then we are offering. We are now graduating into a multi-product company, into the rail subsystems. So we are adding some new products whereby our wallet share per car will currently, from a current level of about 20 to 25 lakhs, will jump to almost about 75 to 80 lakhs. But that is a gradual process. It doesn't happen suddenly. So we are very bullish about this segment and the division. We expect this division to double in the next 2 to 3 years' time, both in top line and bottom line. And that's how the strategies are moving. And this year we have already started supplying. Apart from HVAC units, we have started supplying pantry systems, and now we are getting prototype orders for doors and gangways. So next year, doors and gangways will also come into a larger category. I think that's how this division will move ahead to be a multi-product rail subsystem company moving forward with the technology-led components.
Thank you. Mr. Marda, may we request you to rejoin the question queue for follow-up questions. Thank you. Our next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, sir. Thank you for the opportunity. I have one more medium-term question. So given where we are seeing margins of some of the brands or OEMs, do you think there's a risk that the component manufacturing can also be brought in-house by them and thereby shrinking our target market or addressable market?
Well, on a scale of 1:10, if we say that everybody will start manufacturing all the components, that's not possible. That's basically what happens is we have customers who have only 20% of insourcing. We have customers who have just assembly lines and they buy 100% components outside. And we have customers on the other side who are deeply backward integrated. So they will be at a level of 7 or 8 in the backward integration. But still there is a lot of scope of component supply to even customers which are deeply backward integrated. We are still supplying components to them. So it's just like auto story that if Toyota puts up a factory, they will do car chassis on their own, they will do car bodies, and they will do engines on their own, and in future maybe battery backs and control systems. But will they ever start producing tires and bumpers and steering wheels and seats or audio-visual systems or glasses? So similarly, in our sector, when a brand or a customer puts up their own factory, they generally go with the assembly lines, labs, and heat exchangers, or maybe injection molding machines, and maybe some kind of other equipment. But largely, or maybe compressors, which is not our addressable markets. But generally, we have seen brands, all the brands, like they buy something from us. So our objective is that how can we continue to be a dominant share in the manufacturing footprint point of view. Today we have about 29.4% market share in the complete value proposition, value manufacturing footprint. And even if we maintain this, it's going to be a good exponential growth from here on.
Sure, that's helpful. Secondly, I know it will be different for different components, but on a weighted average basis, what kind of asset turn a new facility, a greenfield facility generally enjoys?
Well, different divisions are at different asset turns. If I talk about electronics, we'll be at asset turns of about 10 to 11. If we talk about mobility applications, our asset turns will be about 12 to 15. If we talk about asset turns of air conditioners, especially in the assembly line, you can reach to 7, 8. But if you talk about complete backward integrated lines, the asset turns can be only 4. So it depends on which components you want to supply to. It varies from component to component.
Thank you. Mr. Andirajit, may we request you to rejoin the question queue? We move to our next question. Our next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, hi, good morning. So Sir, given that we are looking at an industry level decline in the first quarter, can you give us some sense on how this has, played out regionally, in terms of the industry performance? Given that you would be facing both on RAC and components, so you would have some sense of how a particular region has done.
Well, we need to refer to the GfK reports because they are the one which comes out to proper region-wise. We don't monitor region-wise sales because we are a B2B company, so we supply to customers and then they supply further. But what we are hearing from brands and from our customers is that North India was a big dissuader because of continuous rains starting from March end till now. So North is like a complete what shocked the markets, and but otherwise West and East we are hearing that it is going pretty well.
Okay. This is the continuation of the earlier question. Given that we've seen a fairly intense capex intensity over the past 5-7 years, either directly or through acquisitions, etc. When do you think you'll be done with large part of the capex in terms of the growth capability that you have in mind? And therefore, what is the kind of ROC that you have in mind, which will be a sustainable number that we can maintain?
Well, we've done pretty large capex in last 2 years. We've almost spent close to about 1,100 crores. This year we have guided will be in the range of 350 to 380 crores. And so large part of the capex is over. We don't need any more greenfield facilities for air conditioners or for our motor division. They are already shifted to newer plants and all. So we are doing some capex, but maintainable ROCs in our sector on a long-term point of view is between 19 to 21. Last year we did 15%, and this year we are likely to cross 16 to 16.5%.
Thank you. We move to our next question. Our next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Hi, sir. So just needed a clarification on the subsidiary margins on PICL and the electronics division. So we've seen a sequential decline. Should we assume that margins will remain in this level, or it should revert back to the earlier trend? Because in a couple of quarters for at least PICL, we've seen about 14-15% margins.
So it will vary from quarter to quarter because we have some exports coming in, and then there are different product mix we have. Again, I'll reiterate that please don't see the balance sheets in the percentages of margins. It's an absolute EBITDA basis where one need to see the B2B company like us. But because we have a high range of 5 to 22% of EBITDA businesses, so it's very difficult to say that what percentage. But yes, looking into the moving trajectory right now, like we have guided that Sidwal will be in range of 20 to 22%, electronics will be about 5.5%, and motors will be around 9 to 12% range. So that's the range which we operate in the subsidiaries.
Okay. And sir, we've seen a sharp sequential interest cost increasing. So, and you are doing the 350 to 380 crores sort of capex. So, should we assume that in this year we are not going to see any net debt reduction, and debt levels will remain at the current levels?
No, I think so. A lot of cash flows start coming in quarter 4, and we may reduce the debt by 50 to 100 range as per the business plan which we have right now. So I think that looks doable right now.
Thank you. We move to our next question. Our next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yes, sir. Thanks for opportunity. So one, with the industry likely to having a very muted growth this year, so do you see any impact on PLI benefits industry will receive, or is it fair to say that there may not be real PLI benefit that the industry may receive this year? Also, particularly on our company side, the benefit that we received in FY20, what is the likely budgeted PLI benefit that we may in FY24?
So last year we've achieved the incremental sales required as per PLI, and this year also we don't see any issue of reaching to our incremental sales part of it. There may be some companies who may not be able to do it, but as far as Amber is concerned, we are pretty much on track.
Okay, so that's good to know. And if you can quantify the amount of it that we are likely to get.
See, the total we have applied for 400 crores in the PLI. So we are one of the largest PLI applicants. And as per the PLI structure which is there, in next 5 years we should be receiving close to about 270 odd crores as we move ahead. So last year incremental sale PLI benefit we should be receiving this year, maybe in quarter 3 or quarter 4. And this year PLI benefit after the balance sheet is final will be receiving next year. So it will come till 2027, 28.
Okay. So fair to assume that we might be generating a benefit of around 350 crore in this year, 24 and FY23 also.
No, it is. It is gradually increasing because there is a incremental threshold sales target defined in the PLI. So in the first year, like it is for 300 crore capex, it is 15 crore. Next year it is 30 crore. Then it is going to 37.5. Like that, it is on an increasing trend because every year the threshold of incremental sale is increasing based on the incremental capex.
Okay, sure. And absolutely last question. The industry is likely or has almost added now 3 to 3.5 pieces capacity. So do you see any margin impact that may happen in this term because everybody may like to increase the capacity utilization? Yeah.
So there are just I think there are 5 or 6 brands who have put in facilities. Others have not put in facilities. But so I would say the complete changeover of the landscape shift of insourcing outsourcing has almost finished now. So the last leg is remaining by one customer who will be starting their factories very soon, probably by October. Other than that, everybody has started. And there's one more Japanese customer who is likely to start next year. So that's all. Otherwise, more or less, it has settled.
Thank you. Sorry to interrupt, Mr. Joshi. May we request you to return to the question queue for follow-up questions? Thank you very much. Our next question is from the line of Nirav Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. I just wanted to understand, can Sidwal provide air conditioning solutions for trucks, and how? And as government has mandated air conditioning for trucks, do we intend to get into it?
You see, one impact is very sure that once the truck drivers will start sitting in an air-conditioned environment, they will have ACs in their homes also. And once the AC starts penetrating into that community, you can see the exponential jump on room air conditioners to come. Coming to your question on Sidwal getting into truck air conditioning system, I mean, we can give the solutions. We are right now giving solutions on the truck refrigerator reefer parts. If somebody has to come with their older truck and get it converted, we can do that. But we don't see that a large business plan because the notification which has come is from 2025 onwards. And that is pertaining to the newer trucks which will be sold. Newer trucks today also are getting sold with the air condition largely. The non-AC will be converted into the AC part. So what we are focusing is the truck reefer part as well as the bus air conditioning sector.
Got it, sir. And sir, the other question is pertaining to exports. So would it be possible for you to share updates on the exports that we can do in FY24 across our standalone business and across each subsidiary? Thank you.
Yeah, so we are, on the PICL side, as I explained, that export has moved up and we are seeing a good traction. We should be doubling our exports probably in next 2 years' time. On the finished goods side of air conditioners, we have reached, with some customers, we have reached to last leg of getting the BE approval. The prototypes have already started, and next year we should see some volumes coming up for the finished goods also.
And for electronics?
Electronics, we have not yet started any initiatives. We are busy. Our division is busy in India itself. Probably they will create a global strategy once they are very stable in India and start, because they are increasing their footprint into the South India. Now they have put up a brownfield expansion in Chennai, and they have done another expansion in Noida. And they are bringing up more applications in the electronic side. So their strategy for next 2 to 3 years is within India.
Thank you. Sorry to interrupt. Mr. Vasa, may we request you to rejoin the question queue for follow-up questions. Thank you very much. Our next question is from the line of Mr. Pankaj from Affluent Assets. Please go ahead.
Thanks for taking my question. I just wanted to understand what is the total addressable market for us in EMS space, and how are we working on it?
Well, on the EMS side, we can divide this answer into 2 categories. One is on the room air conditioner side, and on the other side is the electronic side. Electronics, you must have seen a lot of research reports that it's both import substitution as well as the domestic market, which is going into the electronic side. Every appliance, every auto, and every other sector are adding electronics into their products category, and that is where the space is. So it's on the electronic side, I think it's an ocean. It's right now close to about $7.5 billion worth of PCBAs are getting imported into country. And if we even just do the import substitution category, it's enough for everybody to get up in that space.
So what are we doing to increase our presence out there?
Well, we are adding customers, so which is helping our nation to substitute on the imports, as well as helping our company to grow into various applications. We started with air conditioners, but today, if you see, air conditioner imports have almost closed in the AC category. So in the AC category earlier, 75% was inverter PCB was getting imported. Today, it has shrunk to almost about 20%. So that is a big change which we have seen in our sector. Then we have graduated into refrigerator, washing machines, and other sectors, plus hearable, wearable, and telecom sector.
Can you please give a guideline of how we are expected to grow, especially in EMS space?
In EMS space, we have already guided. Our electronic division is likely to touch 35 to 40% growth rate this year. Last year also they grew by 70%.
Thank you, sir. Thanks a lot.
Thank you. Our next question is from the line of Kaushik Mohan from Ashika Stock Broking. Please go ahead.
Hi, sir. I hope I'm audible. So my question is basically on your railway segment. So I just wanted to understand as a business perspective, you sell the ACs and the conditioners to the AC railway manufacturers directly, or it goes to the government and then it goes to the person? What's the process of how this works?
It has actually 2 type of customers. One, we have Indian Railways, where Indian Railways have their own factories in Kapurthala, Chennai, Raebareli, and other places. And there are zonal railways also where they maintain and refurbish older coaches. So we supply to all railway divisions. That is where we participate in tenders and we receive the orders. And we supply directly to Indian Railway factories. Then on the metro side, we supply to the train manufacturers, the metro car builders like Alstom and Bombardier or CRRC or CAF, Bemel, who are making the car bodies. So our customers are those in that category.
Got it, sir. Sir, on the last question, how about the margins and payment cycle from the government side for this division?
Well, we haven't seen any issues in the payment cycle. It's quite streamlined. It's a company which is sitting on a positive cash. So in the metro side, we have payment cycle from 90 to 120 days. In railways division, it is starting from 60 to 90 days.
Okay. How about on the margin side, sir? Any guidance on the
Margins on that division, we have already guided. We will maintain about 20 to 22% of EBITDA margins.
Got it, sir. Thanks, sir. Thanks for the question.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question of our question and answer session. I would now like to hand the conference over to Mr. Jasbir Singh for closing comments.
Thank you everyone for joining on the call. I hope we have been able to address all your queries. For any further information, please get in touch with Manish or Strategic Growth Advisor, our investor relations advisors. Thank you very much. Have a good day ahead.
Thank you. On behalf of Amber Enterprises, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.